Good morning. This is James with 77 Financial Group. You're listening to 15 Minutes of Finance, where in the next 15 minutes, I bet I can get you excited about investing. Let's do it. All right. Happy Saturday, everybody. This is James. We're back at it again. We have kind of a boring week. I guess we had a boring week in the market is kind of how I would tone it. But we got a lot of news. We got a lot going on. And as we know, this is an election year. So we have a lot to look forward to. And not in the sense of like excitement, but more of questioning. We have a lot to look forward at, I guess is a better way to say it. But let's go over this last week and just see what happened. So the S&P's 500 index recorded its first weekly decline since mid-April, but still ended May with a solid monthly gain. The market benchmark ended Friday's session at 5,277.51, down 0.5% from a week earlier. The week consisted of just 4 sessions as the U.S. stock market was closed on Monday for Memorial Day. Despite the weekly drop, the S&P concluded May with a 4.8% monthly increase, wiping out its 4.2 April decline. The index is now up nearly 11% year to date. This week's economic data showed U.S. consumer spending weakened more than expected in April, as April outlays on goods fell in the contraction territory. However, the annual headline personnel consumption expenditures price index and the Federal Reserve's preferred core measure, which excludes food and energy, remained unchanged at 2.7% and 2.8% respectively, and were in line with Wall Street's forecast. First off, I got to read that again because that needs to be an acronym and it wasn't. So, however, the annual headline personal consumption expenditure price index, guys, that's too much. I honestly don't even know what that. Obviously, it's a economic indicator, but that's just so much. We don't need to be doing all that. Okay, that's too much for the average person. That's too much for me, and I'm the professional. Guys, this is the last week. NVIDIA gave its earnings. Costco beat estimates. We had a good week for technology, consumers, financials too. It was a good week. And then also we upped our debt. Woohoo! As a country. We solved the debt problem like we do every quarter or every month when they meet and they say, yeah, let's just increase the debt ceiling a little bit. Guys, I kind of wanted to talk about that a little bit with the debt ceiling. And Brandon and I talked about it in the Two Gents, 2 cents, which, by the way, shameless plug, that's going to be another segment we're adding. If you guys didn't hear last week's episode, we're adding a YouTube longer segment. It's going to be once a week, roughly 50 minutes, 40 to 50 minutes. And we're going to be going over just tons and tons of financial content. Okay, so you guys are going to just listen to it on the road, listen to it while you're working out. Something, I promise you, every episode, you're going to learn great things from that. But yeah, we talked about the debt ceiling a little bit. I think our episode covered just different types of investments, gold, real estate, property, rentals, art, alcohol, Pokemon cards, pretty much just anything that you can invest in. And we were talking about the U.S.'s debt. And that was outside of the good news from NVIDIA, Costco, the tech sector. I just think the debt is a weird conversation because, yes, it is bad. And yeah, anytime you hear debt, you're like, ooh, that's not good. But if we take a bigger picture, if we just zoom out a little bit, okay, and we view the government like a income producing entity that it is, right? GDP, that's what the government produces, a country produces. Well, we can compare it then to companies and to individuals because just like an income or just like a revenue, right, a profit, we can compare governments to people and companies. So the reason I bring that up is because companies take loans out, okay, and it's almost always compared to, or the amount of the loan is decided on based upon their revenue, right? Their revenue, their assets, how likely they are to pay it back, their credit score. And then for individuals, it's income and assets. How likely are they to pay it back, aka credit score? So with a government, If we view it just like that, then their GDP is their income, okay? And when we all know mortgages, they're 10, 20, 30, 40 times, sometimes 100 times what is it really 100 times? Probably not getting a $7 million house if you make $70,000, $7 million mortgage. But my drift is, which I hope you're catching, mortgages are an exponentially larger amount of money loaned to somebody based upon their income because they have 20, 30 years expected to pay it back. So if someone makes $100,000, they can definitely get $1 million loan. They can absolutely do that. Maybe even $2 million, $3 million. In 2008, I know that my dad, whenever he was trying to get a loan for the house, they were just throwing more money at him. They were like, why can't we, why don't you want more money? You want more money? We'll do it for you. Obviously, we saw how that turned out. But, okay, back to the government, the country, the debt. I think we're at like 33 trillion or somewhere around there. But, guys, our GDP is in the 20s. In fact, let me just look it up real quick. What is our GDP? 2023 USA GDP. Oop, not GSP. George St. Pierre, shout out. 27.36 trillion. Okay, so we're almost a 1-for-1 income to mortgage loan. Okay, if we're using that comparison. People do that all the time with their houses. They take out these large loans. If we look at the government just like that, I don't think it's as big of a deal as people say it is. Now, the only difference is the government increases that loan every single year. So that, and it's exponentially more, right? Like back in 2000, if we increased the debt by 4%, it was maybe $1 billion. Well, now if we increase it by 4%, it's billions of dollars, right? So every year, if we keep doing that, obviously we're going to get to quadrillion, I guess would be the number. If we keep exponentially going at the rate that we're going, it'll be insane the amount of money we owe as a country. But I just don't think it's that big of a deal right now the way people think it is because, again, it's an income-producing entity. We have millions of those, billions if you count people, who take out loans just like the USA debt to buy houses. So that's just a different perspective on it. I know it's not quite 1-for-1, but it is comparable, I would say. But now let's talk about, again, the government. How is an election year going to affect the stock market? And I've been really thinking about this, doing research. Look, there's data going all the way back to, I think like the 1910s is really when it was prevalent. The difference between a Republican and a Democrat, what it did for the stock market in that year. And then there's data for the year after. So if you get elected in November 2024, the data would show, well, what did 2025 do, right? And that goes all the way back to like the early 1910s. And it doesn't really matter. The difference is 1 or 2 points. Okay, so I think like the Democrats maybe in the year of is 6%, and Republican years, or if they get elected, it's like 8%. And then I think the year after, Democrats have a better return than the Republicans. Or maybe it's vice versa. It's one or the other. It's just so incremental that it's more, I wish they had the data on the 4 years, right? And I'm sure someone out there has the data, but none from an accredited source that I thought would be viable to bring up. Look, both sides of this same coin, okay, they both tax you, right? So we'll use a coin. They both result in growth, okay? Now, obviously, the Jimmy Carter years, we remember those years, at least if you learned, he's arguably the worst president of all time. Yeah, there are some years where it was horrible. But again, if you would have said, oh, I know it's going to get better, taking the Warren Buffett approach and just put money in anyway. Okay? If you have an income and you have an income for more than 5 years, so if a presidential term is 4, if you have more income, if you know you're going to have income for 5 years, I would just be dollar cost averaging it, dumping it in every single month. Okay? Don't even look at it. Warren Buffett's famous quote, I don't know what the stock market's going to be in 20 years, but I know it's going to be higher. And I was talking to a younger advisor the other day about just like the political aspect of investing during years like this. Like, oh, the stock market's at all-time highs, but inflation sucks, and there's bottleneck with transportation, and there's wars all over the world, and McDonald's burgers are 80% more expensive than they were in 2010. Where's the $5.20 nuggets, McDonald's, darn it? All of those things, why, with all those things impacting the market, why is it at all-time highs? Like, why are we continuing to boost it? Is it political manipulation? Is it this administration wanting to boost it so that way when it comes time, like, hey, look at the market, look at what we're doing? Maybe I couldn't tell you. I can tell you that in my field, even the product people, which again, if you remember, if you know me, I don't like investment products. Investment products come with too much. You surrender too much authority over your own money. I'm not a big fan of them. We do some of it, but very little. Okay. So usually with an investment product, you're getting some sort of guarantee, but you can't access your money for a period of time, 2, 3, 10 years, whatever it is. So the investment product people, we call them wholesalers. They're knocking down my door, emails, letters, gifts, right? Some of these people send wine that never even met them. I don't even know their name. And they're trying to get a meeting with me. And they're selling these products, structured notes or annuities or a hybrid product with these guarantees. And usually they're really good guarantees. Now, what I think that is we're going to follow the money, right? If these big companies are selling these products with these excellent benefits, right? So maybe there's a structured note that says, hey, for the next 5 years, if the stock market does 20%, you'll get 18% of that guaranteed. Or let me rephrase it. Sorry. You'll capture 90% of the upside of whatever the stock market does, but if it goes down, you won't take any hit, right? And that sounds really good. It sounds good. But if they're selling things like that, then what does that say about their aspect or their forecast for the market, right? When I hear that, I hear, wow, they think it's going to do good. They're able to do something to guarantee, which I'm blown away. In fact, let me just look at you guys are getting the inside scoop here. Let me see if I can find the structured note email I got. So this is very fascinating to me, I think. Okay, here we go. This is an email from a legitimate wholesaler. Okay. Okay. Good afternoon, James. Hope all is well. I wanted to reach out and highlight this new custom note we recently launched with Goldman Sachs. This note pays you 15% per annum, so per year, as long as the worst performing of Amazon, Apple, and Tesla is not down more than 40% each month. This note also has a 1-star feature. 1-star means that at maturity, if at least one of the underlying close above the initial strike level, you will receive the full principal back regardless of whether or not the worst performer has reached the barrier level. Okay, first off, even me, I would have to read that 6, 7, 8 times and break it down so I fully understand it. Now, I get like a window shopping understanding of this product, but I would still have to dive deeper. Long story short, they're basically saying, hey, we think the market's going to do really well. In fact, we think Amazon, Apple, and Tesla are going to do great. And we'll be, you want protection on the downside, but you want to get exposure to the market. We'll make you a guarantee. And then they guaranteed you 15% based upon those, parameters that they gave. I say all of that just that the wholesalers, even the people selling these products, think the market's going to do good. They do. They think it's going to do great. Now, does that mean they're right? No. There's another, I think this is actually Rothschild, not Warren Buffett this time. I can't remember who said this, but there's a quote that said, you should invest when there's blood in the streets. Meaning when everybody else is panicking, you should saying, this is my time. Let's attack. Let's pounce. Let's take advantage of the opportunities, right? You're an opportunistic investor. So I'm trying to be wise and discerning about what do I think? What do I really think? Guys, I don't have an answer right now. I need to wait. I need to wait out the summer. Usually summers are bad, just in general, right? Sell in May, go away. That's a saying. But May was good. So it's possible that the rest of the summer is also good. It's just too hard. It's just too hard to tell. Now, there's two directions it could go. Okay, if we're able to get inflation down before the end of the year, that absolutely will positively affect the stock market short and intermediate term. If that stays and we have if inflation stays and we have other negative news throughout the world, man, that's going to affect the market, I think. Just because I think there's going to be, what is diamond hands or people that hold forever. We're going to have some real paper hands, okay? People that are just taking their money out because they're scared. And that's going to affect the market right away. But I'm on the Rothschild side. So if I see that happen, I'm dumping money into the market. And right now, I would say a majority, if I did not have clients invested, so like when new clients come over, like we just rolled over a couple of new clients, I didn't put them all in the stock market. I put about maybe 45% of, and I'm just using the most recent person that comes to mind in the market. And then the other 60% I just put in treasuries right now, 3 months treasuries. We'll see what happens in 3 months. And then that opportunistic time will come and I'm going to call that client and go, hey, I think this would be a great time to get in. It's down 10%. The stock market is, what do you want to do? And just have that conversation with them. So, and every client's different, right? Like for me, I'm not going to sell nothing. I'm 31 years old. Brandon, he's 30 years old. He ain't going to sell anything. So that's just the perspective with the political environment, how it's going to look. Guys, I don't think we can be scared. Right? People get scared with the stock market. And I, for the life of me, can't figure out how to get people to not be scared. It should only be exciting, in my opinion. Okay? Because things are temporary. And if at any point there is such a bad event that your money goes to zero, you won't care about your money at that point. That's just the truth of it. So, guys, all that to be said, I hope you're investing. I hope you guys are excited about it. And, real quick, newsletter. We have our June newsletter coming out, okay? We have a paid newsletter coming with stocks to watch, stock picks, stocks that we picked for you to watch, market outlook, insights, why we like certain investments, why we like certain sectors, why we don't like certain sectors. Put my heart and soul into this newsletter for you guys, okay? And this newsletter, this is for people who don't want an advisor. They don't want me managing their money. They want to do it themselves. Okay. But they want also just to see like, I wonder what 77 is doing. I wonder what James thinks about this. I wonder what the people who look at this all day think. So that's coming out here in June. I think monthly is, I'd have to talk to our team, but I think it's $9.99 a month or it's $100 for the year. Okay. So you get a discount for the annual. It's called the Trading Desk and you can get it at our website, 77financialgroup.com. So, guys, with that said, I hope you are excited. I hope you guys are having a great weekend. As always, invest early, invest often. Have a good one.